Transmission equipment stocks, which are coming under pressure this morning after the government granted a 2-year exemption under the public procurement order, allowing 4 Chinese companies with manufacturing facilities in India to bid for select PSU transmission projects. Snehi is here with the details on why these stocks are seeing pressure.
Well, yes, massive pressure on names like Hitachi Energy India, Siemens India, GE Vernova, T&D, CG Power, BHEL, and a whole host of other stocks belonging to this group of stocks. Let's understand why this has happened. Today, the government has granted a 2-year PPO exemption to 4 Chinese-linked electrical equipment manufacturers to supply in India. Now, these companies are TBEA Energy India, Takai Electric India, Nanjing Electric India, as well as New Northeast Electric India. These are some names that you should be focusing on. This exemption allows participation in select PSU transmission equipment tenders despite existing procurement restrictions. The Ministry of Finance has approved exemptions following the recommendations from the Ministry of Power, and this is negative for the existing players in this segment. The exemptions primarily address domestic capacity shortages in critical transmission equipment manufacturing, and the policy aim is to prevent project delays until there is a sufficient domestic manufacturing capacity that becomes available. Now, to understand why this is negative for the incumbent players, Chinese suppliers increase competition in the premium transmission segment. There could be greater bidding participation, which could put pressure on the Indian companies. Competitive bidding may also undermine the capability of the Indian companies. PSU tenders may witness lower bidding prices. Domestic manufacturers could lose market share. Existing order pipeline may be affected going ahead as well, and it is a negative in terms of sentiment for all of these existing companies. In terms of the segments that are the most affected, 765 kilowatt and 400 kV power transformers, extra high voltage capacity, HVDC transmissions, all of them stand to be affected. And so some of the biggest players in these categories include names like Hitachi Energy India, GE Vernova, T&D that competes directly in the high voltage transmission equipment segment, Siemens India, CG Power, BHEL, Tyrrell, as well as Volt Amp transformers. Just to give you a little bit of brokerage view on this, ICICI Securities believes that this is applicable only to Chinese companies who have plants in India. This was along expected lines and should not have any material impact, but the stock reaction is saying otherwise.
Okay.
Thanks, Snehi, for that. I think we have another management joining us, Varun Gupta, whole-time director, Ashiana Housing. Varun, hi, morning. You gave a guidance of nearly 2,200 crores in terms of pre-sales, did around 358 crores in the first quarter. Are you able to meet that guidance, or are you going to see a heavy second half that will help you meet that guidance?
Hi, I think we should be able to meet the guidance. The plan has been skewed anyways towards Q2 and Q3. Q2 because a launch of a Ashiana Oma project will get recorded for sales. Then we launched it in the month of June for expression of interest. It's a large project with about 280 units in 2 phases that we are launching. And in Q3, it might be Q3 or Q4, we are planning to launch the last phase of our Ashiana Housing project in Gurgaon. Both those together will contribute significantly to our sales, and the pre-sales guidance of 2,200 crores remains.
What are the key factors behind relatively softer bookings in the first quarter?
So 2 things. One, in Jaipur, we don't have really a significant amount of stock to sell outside of the Ashiana Oma project, and the team was also concentrating towards that. So there is a timing gap in the quantum of sale that, let's say, Jaipur would record getting skewed towards Q2. And in Q1 last year, Jaipur had significant contribution. And second, in one of our other markets, which is Bhiwadi, we are out of stock in the premium homes category, which had a very significant, like 150,000 square foot contribution in the Q1 of last year, which is Ashiana Tarang, which is also sold, mostly sold out. So we have really no stock left to sell there effectively. So that has been the biggest driver of a little bit of softness in the Q1. The good part in Q1 is the company is pivoting towards senior living as a larger product. Let's say over the next 3 to 5 years, we would like to make senior living 50-60% of our business from about 20-25% of our business right now. And in that, perspective, the senior living sales during the quarter were about 130 crores plus, and which is a good sign. We are on track to continue to grow the senior living overall annual sales. Last year we did about 569 odd crores, if I remember correctly, in the year, which we will be growing this year. And that's going to be the big growth driver from a long-term perspective in the company.
And how's the execution pipeline looking for you, at least in the current year? I'm not talking Q1 because maybe you're on silent period where that is concerned, but talk to us about FY27 as a whole.
So FY27 as a whole, we have given what all we expect to deliver in our deck. I think our revenues are expected to be close to a tad bit short of 2,000 crores total if we are able to meet our targets of deliveries. Q1 was a little soft because all we have delivered is phase 1 of Ashiana Nitara project, and that is also a very small project, which we have already given in the update as to what the delivery has happened. But there are lots of projects which are scheduled to be delivered over the year. We are generally on track to deliver them. Construction is progressing as per schedule. Sometimes, if anything, I think more than construction, slippages in getting OC from the government would be the key aspect that we need to ensure that we're able to get that. If we get that, then we will be able to meet our revenue guidance for the year as well.
And give us a sense as to how labor shortages, etc., are playing out. Would that at all delay execution? Are you seeing that as a possible challenge on ground, at least at this point? Has it improved at all over maybe the last few weeks? Because that's what we're hearing.
Okay, so over the last few weeks, things have certainly improved. Overall, labor availability is improved. Also, material supply availability had improved. We were a little concerned in Q1 with how things were going because of both supply of materials and worker availability overall in the market. Things have eased, and as of now, if the current situation continues, I think we are on track.
Can you also give us a sense of, you are betting big on senior living segment. What is the kind of launch pipeline that you have there, and maybe over the next 5 years, what kind of revenue contribution that it will have to your top line?
So right now in senior living, we have 4 operational projects, and we have 5 projects to launch over the next 18 to 24 months. We have 3 in the Bombay-Pune region, 1 in Chennai and 1 in Bangalore as of now. We are scouting for 5-6 more projects to add over the next 12 to 18 months. Over the next, let's say 3 to 5 year, let's say FY30, we would be expecting senior living to do 1,500 crores plus of pre-sales within FY30. So from 569 last year, so let's say in a 4-year time frame, we would expect it to nearly triple.
And what are the margins looking like in terms of how do you expect those to shape up? Senior living gives you better margins, if I understand that right?
Yes. So senior living in general gives better margins. And the other reason to be in it is we think it will be less cyclical than the other regular residential business. So we expect margins to be stable there and not oscillate too much because of the sort of brand we have built and the kind of positioning we have built in senior living over the last 20 years. And overall, as I would say, the margin profile in the company in general should improve year on year. This year's margin should be better than last year's, and FY28's margin should be even better than FY27 on a reported basis. Just because the projects that are coming up for delivery in general have better margins than what the projects were delivered, let's say, last year and the year before. So we are in the zone of overall margin expansion over the next 2-3 years.
Right. And my analyst tells me that you've revised the delivery timelines for Amara Phase 1 and Anmol Phase 3.
Yes.
Has there been a delay there? What's the reason for that? What's the what's the likely impact on revenue, cash, etc.?
So, from a full year basis, they will have very little impact because we are just moving it from one quarter to the other. The projects are complete in terms of construction. We have been facing challenges in getting OC. I think we underestimated the timeline that it'll take to get occupancy certificates. So which should come in the next quarter, and we should deliver on that basis. The projects are fully ready in terms of construction.
Also, if you can give us a sense of the kind of cost escalations that you have seen, inflation that has hit you in the last couple of quarters. There have been flux with respect to labor, material costs have gone up. How are you managing that cost as well?
So the costs are, they are what they are. I think annual inflation for us has generally been in the 4 to 5% range. I would expect this year to be closer to 8 to 10% because of these other shortages and that has happened. So material prices have gone up. We do expect them to come down after a quarter or so. Let's see how that happens. My expectations would be as crude has come off, as gas supply improves, as labor supply improves overall, hopefully the kind of inflation we have seen in the last quarter will not sustain. But we'll get to know that in a quarter or two. That said, even with that, I think margin expansion is expected because the projects were sold at good prices. We did get a lot of inventory gain on our land stock, and that is going to sort of play out over the next 2-3 years.
Varun, thank you so much for coming in and speaking to us.
Thank you.
All right. What we'll do is slip into a very short break. Come back with more. Stay with us. Welcome back, and we're joined by Asad Daud, who's the chairman and managing director at Aeroflex Industries, joining us. I mean, the stock has been on a tear over the last year or so. They've hiked, in fact, the capacity for SFN skids. Now, this is a product which is used in the data centers to ensure that the coolant flows through the data center and ensures that the heat is controlled over there. Asad, great having you. It's been a while since we chatted. But first, give us a sense. This ramp up in capacity from 6,000 to 9,000. The target is to get to 21,000 by end of the year. Am I right in the way I'm looking at the increase in capacity?
So, first of all, thank you for having me.
Great.
The ramp up of the capacity is planned from earlier. We had planned in January from 2,000 to 15,000. And out of that, we have already completed the ramp up to 9,000. And the remaining would be completed in the next few months. So that's the idea for this financial year. Obviously, once this capacity is commissioned and under production, then we will look at further ramp up in capacity going forward.
6 to 9, you did it in the current quarter, in the sense Q1 FY27. Am I reading the timelines right?
Yeah. So in this quarter, in the last quarter, which is Q1, we ramped up the capacity from 6,000 to 9,000.
And if you had 6,000 at the start of the quarter, you've done 1,050 in terms of sales. The production capacity, my understanding, would be 1,500, just kind of apportioning it, divide by 4, right? You've given annual capacity 6,000, 1,500 should be quarterly. Any reason why you've done 1,050?
So generally in this industry, the capacity utilization ranges between 70 to 80%. So based on that capacity utilization, we have utilized. Also, what happens is, when you get the capacity, commission, it takes a few while to get the entire capacity into production. So there will always be like a month or a month and a half lag. So you'll see the ramp up for the in terms of the production coming in Q2.
And therefore, Asad, how should one look at full year for this product in particular? Because the ramp up of this is going to be very sharp. I'm trying to understand what impact does this mean for units YOY, and so basically volume YOY, and for top line, how much does it contribute to top line for the full year?
So in terms of volume, if we say last year we started the sales of this particular product in the month of December itself, towards the later part of December. So it's basically just 1 quarter of last year that the capacity was in place, and also at that time the capacity was only up to 2,000 units per year. The ramp up in the capacity has happened in Q4 of last year, and then obviously in Q1 of this year. So we'll see a really significant jump in the volume sales in the current year, and we expect that this year this particular division would contribute at least 20 to 22% of our overall sales for this year.
Hi, morning. What kind of order book that you have for this product, and the demand that you're seeing for this?
So in terms of the pipeline that we see, we have a pipeline up to October and November, which is confirmed with us. And then obviously there are a few projects which are in discussion for the subsequent months. So we have a broad pipeline, I would say, till the end of this calendar year. Obviously, as more and more capacities for data centers starts commissioning and starts getting into into construction phase, we'll see more orders coming in, because we are working with our partner who has the highest market share for liquid cooling in the entire world.
And if you can give us a sense of the kind of revenue contribution that we are going to see in FY27 from this product alone by the end of the year, as the order book you are going to supply, what would be the revenue mix change that will happen because of this?
So last year, this product segment contributed about 5% of the overall revenue, although it was just about slightly more than a quarter of contribution in last year. This year, we expect this business to contribute at least, like I said, 20 to 22% of our overall sales. So it will be a significant jump. And over the next 2 or 3 years, we expect this business to contribute at least upwards of 30 to 35% of our overall sales.
Do you see enough orders coming not just from India but also from overseas market as well?
So for this particular product, we are right now focusing on supplying in India. We have not yet started any supply internationally. But I would say in the future, we may look at international expansion for this particular product as well. But right now, the focus is in India.
And give us color on competition, Asad. Pricing, competition, is that at all a challenge? How commoditized is this product?
So, technically, this product has just been launched in India per se over the last, I would say, less than a year. So it's a very new product in the market in India. Even I would say liquid cooling itself is a concept which is not more than 3 years old, right? Even internationally as well. So we are among the first players in India to manufacture this particular product. Obviously, as the demand for the product increases, and that happens in any industry, there will be a competition coming in. I think when the competition comes in, then we'll have to be more aggressive in terms of our cost optimization, and also look at the pricing. I think right now the focus more is on the supply, and I think over the period of next year or so, I think we'll look at optimization of cost and efficiency.
How are other product lines doing, Asad? Give us a sense of that. And also from SFN skids versus other products, what's the kind of growth clip over the next couple of years that one can expect?
So we are seeing a very strong demand coming in from both the US and the European market for our core products, which is the assemblies, the hose assemblies. We are seeing increase the number of orders coming in, especially from the US, especially after the tariff was eased in the month of February, because the last year a certain portion of our business or the growth that we were expecting to come in from the US did not materialize to that extent. because of the tariff situation last year. But we are seeing a lot of demand coming in from the US, especially after February. And also we are seeing a strong demand coming in from Europe as well. Also, some of our hose assemblies also go into the data center, as part of the cooling systems.
Okay. And how should just give us your typical revenue growth guidance and what should margins look like maybe over the next couple of years? What should the growth clip look like? What should the margins look like all the way through FY28?
So the idea is that, this year with all the ramp up in capacity that we have done last year, plus also that we are doing in this year specifically for skid assemblies and also for hose assemblies, I think we'll see a significant bump in both the top line as well as the bottom line for this year because of the capacities that we have or we have already built, and some of it are in pipeline, will be commissioned in this year. So this year we'll see a significant jump in sales. Over the next 2 to 3 years, the idea is to increase both the top line and the bottom line at a rate which, if you see the average our growth over the past 4 to 5 years, right? We expect to have a much higher growth rate in the future based on all of these business segments and verticals that we have entered into.
Okay, Asad, thank you so much for coming in and speaking to us, even though a larger conversation well warranted, because this is just such an evolving space. And Asad, we'll place that request with you and we'll probably convert that into a conversation maybe over the next week or so. Thanks so much, though, for joining in.
Thank you.
All right, viewers, completely timed out on this edition of First Trade. Stay with us. More on the other side.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी केसरिया से मन जोगी हुआ रे दिल झूम देखो मतवारा हुआ रे केसरिया से मन जोगी हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
Every business is like a piece of land. From the outside, it looks ordinary. The real truth lies beneath. Dig once, you uncover losses. Dig again, unexpected profit shines back. Sometimes it's the heavy chains of debt. Other times the break of fresh cash flow. But deep below, traps wait. And if you keep digging, you strike the jackpot. The real metrics, the real value. This is all about your company, where we dig deeper so you invest smarter.
Large scale AI. If you are not scaling AI, I think you're just sitting there as an observer while the industry is rewiring. So I think the time for scaling is now. You have provable sovereign control. over your data, applications, and infrastructure. That's the name of the game.
Sandeep Patel, Managing Director, IBM India and South Asia, on the interview.
Hi there, good morning. You're watching Midcap Masala on ET Now. I am Snehi Shah, and this is a show where we're going to be diving deeper into the broader end of the market, give you a better sense of what's happening with the market. The market as of now is holding up rather well. The broader end of the market is also holding up pretty well for itself, and you're seeing good moves coming in. That's the Nifty 50, 24,350 thereabouts is where we're at right now. 0.7% uptick is what we're seeing over there. Just want to take a look at what the Nifty Midcap is doing. 0.2% higher, not much happening on that front. And the small cap space, that one has been outperforming the breadth of the market for the last couple of trading sessions. Let's pull up the Nifty small cap and take a look at what's happening over there. 0.2% higher. That's the Nifty Small Cap 250 index that we want to be looking at right now. And yes, 0.3% higher is the kind of move that we're seeing over there. Let's also take you through some of the biggest buzzers from the broader end, and that's PB Fintech that is under massive pressure after around 1.16 crore shares or 2.5% equity changed hands in two block deals. The transaction is likely to have been executed at around 1,604 rupees per share, with Temasek Holding subsidiary Mac Ritchie Investments emerging as the likely seller. Next up, also throwing the spotlight on Blue Spring Enterprises. That stock was doing very well for itself. It was up 10%, has moderated significantly from there. Nonetheless, continues to hold on to gains of 5%, and the company is in focus on the back of an order win that the arm has secured in terms of operations and maintenance contract worth nearly 1,437 crore rupees from Vedanta Aluminium. This order is for the O&M of Vedanta's 1,215 megawatt captive power capacity. Shifting focus then, PC Jeweler on the back of its strong Q1 update, holding with gains of about 4%, reported a 21% year-on-year rise in consolidated revenue for the June quarter, supported by strong demand despite elevated gold prices. The company said it has repaid over 90% of its bank debt and expects to become debt-free during the current September quarter, which looks very good in terms of commentary, and the stock is holding to gains of about 4%. Next up, let's also talk about Ujjivan Small Finance Bank. Reported a strong June quarter in terms of the business update, with loan growth of about 29% on a year-on-year basis. Deposits also grew 25%. CASA was up 38%. They've also reported about a 40% jump in disbursements and improvement in their asset quality. And despite the healthy operating metrics, the stock is reacting negatively in trade. A 3% cut is what we're seeing over there. But shifting focus, let's talk about Titagarh Rail that has entered into strategic collaboration agreement with TUTR Hyperloop Private Limited, a technology company specializing in hyperloop propulsion and advanced mobility technologies. The collaboration aims to develop first-of-its-kind hyperloop technology-enabled freight transportation solutions from India. It's a significant development. Nonetheless, the stock is under pressure of about 0.5%. And that's also for the spotlight on DLS E-Services. The company has acquired a 100% stake in Atyati Technologies for 157 crore rupees, strengthening its AI-driven banking solutions and technology capabilities for banks and financial institutions. Stock holding up with gains of about 2%. But shifting focus then, let's get started with all the management conversations that we have lined up on the show. We've got the management of ESAF Small Finance Bank joining us. Mr. K. Paul Thomas, the MD and CEO of ESAF Small Finance Bank, has joined us on the back of their Q1 update. Thank you so much for your time, Mr. Thomas, and good to be speaking with you this morning. The bank has delivered yet another quarter of strong business growth. How should we think about the balance between growth and profitability going forward? If you could quantify the kind of growth you are penciling in for the rest of the financial year as well?
Good morning, Sneha. Thank you for having me on this show. So we have reported a very good Q1. Overall business have grown 25%. Our deposit has grown 18% on a year-on-year basis, and assets also grown 27%. Very good disbursement also compared to Q1 FY26. There is a 9% increase in disbursements also. So overall, we are seeing the credit growth is very promising. We expect the same growth will continue. It will be bit better than the Q1 actually. Normally, you know that Q1 the growth will be little subsided, but this year we see growth, the expected growth in the Q1 also it happened. So we are expecting the remaining quarters also with the same level. So profitability will be matched to the growth. So we are not taking any in the cost of we are not growing on the cost of profitability. So profitability will also be matched with the growth.
Not growing at the cost of profitability. That sounds good going ahead. Mr. Thomas, you've reiterated your aspiration of delivering 20 to 25% loan growth in steady state. Where do you see incremental growth coming in from the next few quarters? And are we on track for this 20 to 25% growth?
Yeah, so we have got a very good franchise we built over the last 9 years. 821 branches, banking outlets spread across 26 states. Also, we have a very strong business correspondent channel, 35 institutional business correspondent partners. They are managing 1,065 customer service centers. So these are all evolved. These are all mostly new centers. So these existing branch network and the BC network, if you properly leverage, this itself definitely will bring the expected growth, and the growth will be in the south market definitely, because we are very strong in the south market, and the new market in the north and the eastern zones also will, because there are so many new locations we have opened last 2 years. So that also will bring us growth. And West, we had a very good presence, and we have been very strong in that, in the Maharashtra, Chhattisgarh, MP, the Central India and Western India region. We are very strong. So also the product strategy we have adopted from 22 onwards, the MAG, MSME, retail, agri, and gold. So the Q1 we have seen 35% growth in this MARG category. So we are expecting that this growth will continue in these product portfolios in these coming quarters also.
Okay, that sounds good. And Mr. Thomas, you did mention some of your segments. Let's talk about some of them. Retail and other loans have grown strongly. They continue to do so, while the microfinance portfolio has been largely flat on a sequential basis. Is this a conscious decision, or is this a mix that you are aiming for, or are you seeing softer demand on ground for MFI?
Yeah, there is demand for MFI loans. So we have decided to maintain a 30-35% of micro loans. Or I'm not saying it is micro loan, will be saying it's unsecured loan. So the rest will be serving the same customer segments with various other products. So that's what we are doing. So we have got many MSME products suitable to the graduating clients from the microfinance, and we have introduced affordable housing product for these segments. So these segments will continue to serve the low middle income segment. But unsecured book we will keep at around 30 to 35%. As of now, it is 38%. So going forward, we'll bring down to the 30-35 bucket. That's the plan.
You did speak about affordable housing finance as your segment. What is the kind of growth that you're seeing over there? What has the response been to this introduction?
This is a new product we have introduced this year. Actually, so the growth is yet to come. We are going to see, but overall, the mortgage book, we are seeing close to 45% growth. We are seeing year on year basis.
Okay, so that sounds good. And you've spoken about how you're planning to bring down your unsecured portfolio from about 38% to 30%. But let's talk about the secured portfolio. That has now increased to over 62% of advances, which is a meaningful improvement. How much more room is there for this mix to improve? And what would your portfolio composition be in the medium term? I understand 30% is unsecured, so 70% is the aim that you have for the secured portfolio, right?
Yeah, 30% is not an immediate quarter, but it will in the little medium term strategy which we are planning. So on the MARG book for gold stands at 42%, and other secured assets like mortgage, agri, MSME, mobility, all put together another 20%. So we are seeing now we have established area asset centers in different parts of the country in our operating areas. So we are strengthening the field level decision making. So the credit teams and asset ops teams are being placed in these area asset centers. So going forward, we are seeing that disbursement in the mortgage and agri and MSME will grow, and around out of 821 branches, around 700 branches as of now we are offering gold loan, and we are expanding to other branches also. So almost 100% branches will be having gold loan facility, so that gold loan book also will grow. So that's the plan.
Okay, that sounds good. And Mr. Thomas, as the portfolio over the medium term, of course, becomes increasingly secured, should we start to expect to see lower yields to be offset by lower credit costs and better operating leverage?
Yeah, it is not purely lower yield. So one thing is that there will be lower credit cost and lower operating cost for the secured book. But we are also expecting a NIM of to maintain a NIM 7 to 7.5% NIM. We are expecting to maintain.
Okay, 7 to 7.5% is your NIM target. That looks good. And you also reiterated your target of achieving 2% return on assets by FY28 with improvement expected over the next couple of quarters. How is the ROA shaping up? And when you say improvement, could you quantify that for us, Mr. Thomas?
On the improvement side, actually, the micro loan collection efficiency has improved for the loans we disbursed during the last 18 months has improved to 99%, 99.5%. Slippages have significantly come down. So we are expecting a lower credit cost in the coming quarters. And ROA expectation is 2% plus. We are expecting a ROA. Lower credit cost, lower operating expense will provide this ROA. That's your expectation.
Okay, understood. And that sounds good. On that note, Mr. Thomas, thank you so much for your time. It was so good to be speaking with you today. Thanks so much.
Thank you, Sneha. Thank you.
Thank you. Okay, so viewers, on that note, it's time to slip into a very short break. On the other side of the break, we're going to be joined by a value retail company. We have the management of V2 Retail that's going to be joining us on the other side. So stay tuned, and that's a conversation you don't want to miss. And we'll be right back after this short break.
केसरिया से मन जोगी हुआ रे दिल झूम देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
केसरिया से मन जोगी हुआ रे दिल झूम देखो मतवारा हुआ रे केसरिया से मन जोगी
हर पल मनाओ केसरी त्योहार। विमल, बोलो जुबान केसरी। जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, India's leading producer of stainless steel.
Every business is like a piece of land. From the outside, it looks ordinary. The real truth lies beneath. Dig once, you uncover losses. Dig again, unexpected profit shines back. Sometimes it's the heavy chains of debt. Other times the break of fresh cash flow. But deep below, traps wait. And if you keep digging, you strike the jackpot. The real metrics, the real value. This is all about your company, where we dig deeper so you invest smarter.
India's real estate story is no longer just brick and mortar. It's a $1 trillion vision powered by capital, policy and innovation. Decoding the roadmap of tomorrow. From REITs to RERA 2.0. From inter-country investments to AI-led PropTech transformation. And the rising importance of sustainable ESG-driven development. This is where India's skylines and its future take shape. ETNow.in Realty Conclave and Awards 2026.
Deep dive, the story behind the numbers. Markets move fast, too fast.
And let's talk about V2 retail. Yesterday and over the last couple of days, we've seen a lot of updates coming in from value retail players. And V2 retail is one such company that came out with its Q1 update. And it was a very strong update. Just taking you through what those numbers look like. Standalone revenue has come in at 997 crore rupees, which is up more than 58% on a year-on-year basis. High double-digit revenue has been clocked despite an elevated base. And the same-store sales growth look at 7.5% looks good. What really looks good is the store addition. They've added 57 new stores already. Remember, they have guided for about 170 to 180 stores in FY27 with a possibility to cross 200, and 57 stores already in the first quarter proves more or less that the company is in line and in fact on track to achieve this goal. Let's take that conversation ahead. So much more to decode from these numbers. We've got the management, Mr. Akash Agarwal, the whole-time director at V2 Retail, joining us on the show. Mr. Agarwal, hi, good morning, and in fact good to be speaking with you again. Let's start by talking about your Q1 update. Your Q1 has seen revenue grow by over 58%, while the same-store sales growth remained healthy as well. What were the key growth drivers and how much of this momentum is sustainable for the rest of the year?
Yeah, hi. So thanks for having me. And again, we were able to, exceed the guidance that we had given of 50%. And hopefully we can continue throughout the year. And it was driven mainly by the 7.5% SSSG that we showed with our mature old stores, and with an addition of 57 stores this quarter and all the 134 stores that we opened last year. It's all driving good sales because most of our new stores are profitable, EBITDA positive, and we've got a very good response through our geographies wherever we've opened a new store. So I think the momentum is good. And we are very positive about the future outlook.
Okay, that sounds good. And Mr. Agarwal, was the revenue growth primarily driven by network expansion? Was it, how much of it came from your relatively newer stores, and how much of it came from your existing stores? What's that mix looking like?
So about 7.5% is from the old stores, the stores that we had at the end of FY25, and about 50% was through the new area that we have added. So that's the split between the two.
Okay, that sounds good. And also, let's talk about your guidance. Overall for the entire year, you've guided for SSSG between 8 and 10%. Quarter one has come in at 7.5%. Do you expect growth to accelerate over the coming quarters now that you've got the entire festive season that will start to kick in? And this 8 to 10% number, how easy or how difficult does that look to achieve right now?
I think over the period of the whole year, 8 to 10% will be achievable. There were less wedding dates in the first quarter, so that had a negative impact for about 20-25 days. But I think we should be able to cover it up throughout the year. Anything above 7% is a very good SSSG number because our base is much higher now. But yes, for the whole year, the guidance is still 8 to 10% SSSG.
So that sounds good. And also, you've added about 57 stores in quarter one. And the last time we spoke, I remember you had guided for 170 to 180 additions this year with a possibility of even crossing 200. Is the expansion on track? And are you seeing enough demand to support this pace? Because your quarter one store addition has been very healthy.
I think that possibility has become the new target now. We will open more than 200 stores this year. Like I said, we are getting a very strong momentum, and wherever we entered almost 9 new states in the last 18 months or so. And throughout geographies, throughout states, customers are loving us. Customers are loving our assortment. They're loving the product. And the new stores that we've opened, they're already operating at a very high level of 750 to 800 rupees per square feet of sale. So I think these numbers are very promising, and that's why we've increased our store opening guidance for this year also. We will open more than 200 stores.
Okay, sounds very good on that front. And, you've also guided for around 50% revenue growth in FY27. After a strong first quarter, you've already seen more than that in terms of your quarter one revenue itself. While you've hiked your store addition guidance, are you looking at hiking your overall top line guidance too?
No, I think we would like to stick to 50%. Okay. It's always better to underguide and overperform. And I think we'll stick to that.
Sounds good on that front. And your sales per square foot, you were talking about how for the newer stores also that's looking very good. That metric also for you in quarter one has improved sequentially from the March quarter. Help us understand if you are seeing this as the beginning of a sustained recovery in store productivity.
So this is not new. I think over the last 10 quarters or so, we have been consistent with our growth and performance improvement. A lot of work has been going into the back end, into assortment, into automations. And I think we've been consistently showing this, and hopefully it continues in the future.
Okay, sounds good on that front as well. And Mr. Agarwal, you highlighted better merchandise planning, higher sell-through and lower markdowns this quarter. What impact could these measures have on margins in the longer term? Can we expect to see margins back into the high teens category?
Because we are guiding for more than 50% revenue growth and we are opening so much new area, margin expansion is a challenge because new stores start at about 70% of old stores throughput. But as these stores mature and the new area that we open is a small percentage of our total footprint, then you will see the margin expansion.
Okay, and if you can give me a timeline as to when that would be?
I think the way things are going, we would continue to expand aggressively over the next 3 to 5 years, considering that the momentum is good and the numbers are good without compromising on any profitability metrics. So high growth period, it's tough to do the margin expansion. But I think after we get out of that aggressive expansion phase, then you will see the operating leverage kick in and the maturity of the new stores.
So would it be safe to conclude that margin expansion beyond that 19% peak that we've seen recently would be seen after, let's say, 3 to 5 years, or can that come earlier?
So again, because we are guiding for a revenue growth of more than 50%, we are not guiding, we are guiding for the similar margin levels. Once we decelerate or we are not accelerating as fast, then we will see the margin expansion.
Sounds good. And lastly, before I let you go, Mr. Agarwal, can you give me a sense on ground? What is the demand for value retail shaping up to be? There is lots of new competition in this space as well. And you are seeing, and in fact, we were speaking to a couple of dealers and they did say that casualization is the new premiumization. That's a statement I've been hearing a lot. Can you attest whether this is a trend that you're seeing on ground as well? And if that is faring well for value retail as a segment?
So see, there are two things you need to understand here. One, unorganized retail is still more than 60% in this price segment in our country. So there's a huge scope for organized retail to take that chunk of the pie. And second, I would say at least 50 to 60% of the population is still not a customer yet because they don't fall into that income bracket. So as the per capita income of the country improves every year, people have more disposable income. They will become customers and enter the target market. So like I said, next 10 years, it's going to be a high growing CAGR sector, especially organized value fashion retail.
Okay, sounds good. And as always, Mr. Agarwal, this has been such a good conversation. Every time I have been speaking to you, you've been hiking your margin guidance. So let's keep that trend going and hope to be speaking with you soon as well. Thank you so much for your time.
Thank you for having me.
Thank you so much. So viewers, that was the management of V2 Retail. Once again, they've hiked their store count guidance for the end of FY27 on track and positively will open more than 200 stores this year, sticking to the 8 to 10% same-store sales growth guidance for FY27. And the 50% revenue guidance that they've given for the financial year, they are maintaining that as well. And yes, margins will expand once they slow down on their expansion phase in the next 3 to 5 years. But until then, they're looking to aggressively add store counts across geographies. On that note, we're completely timed out on this edition of Midcap Masala. Thanks so much for tuning in, but keep watching ET Now because Buy Now, Sell Now is up.